Today we are going to continue the series of investing in stocks in the stock market. But first we need to familiarize ourselves with the various types of stocks, so let us begin. What is the Standard & Poor's S&P 500 index? The S&P 500 is an index of the stocks of 500 large U.S. companies that make up about 80% of the U.S. stock by market capitalization. It is a benchmark for large-cap U.S. stocks and is often used as a proxy for the U.S. stock market as a whole. What is the S&P 500 index for, and why it's important in investing? The S&P 500 index, or Standard & Poor's 500 index, is a market capitalization-weighted index of 500 leading publicly traded companies in the U.S. The index includes 503 components because 3 have 2 share classes listed. It's not an exact list of the top 500 U.S. companies by market cap, because the index includes other criteria. The S&P 500 index is nonetheless regarded as one of the best gauges of prominent American equities performance and the stock market overall. Key takeaways: the S&P 500 index features 500 leading U.S. publicly traded companies with a primary emphasis on market capitalization. The S&P 500 index was launched in 1957 by the credit rating agency Standard & Poor's. The S&P is a float-weighted index. The market capitalizations of the companies in the index are adjusted by the number of shares available for public trading. The S&P 500 is considered one of the best gauges of large U.S. stocks and even the entire equities market because of its depth and diversity. You can't invest directly in the S&P 500 because it's an index, but you can invest in one of the many funds that use it as a benchmark and track its composition and performance. Weighting formula and calculation of the S&P 500. The S&P 500 uses a market cap weighting method that gives a higher percentage allocation to companies with the largest market capitalizations. Company weighting in S&P equals company market cap divided by the total of all market caps. Determining the weighting of each component of the S&P 500 begins with calculating the total market cap for the index by adding together the market cap of every company in the index. The market cap of a company is calculated by taking the current stock price and multiplying it by the company's outstanding shares. The total market cap for the S&P 500 as well as the market caps of individual companies are published frequently on financial websites, saving investors the need to calculate them. The weighting of each company in the index is calculated by taking the company's market cap and dividing it by the total market cap of the index. There are other S&P indices. The S&P 500 is a part of the S&P Global 1200 family of indices. Other indices include the S&P Mid-Cap 400, which represents the mid-cap range of companies, and the S&P Small-Cap 600, which represents small-cap companies. The S&P 500, S&P Mid-Cap 400, and S&P Small-Cap 600 combine to cover 90% of all U.S. capitalization in an index known as the S&P Composite 1500. S&P 500 Index Construction. The S&P uses only free-floating shares, the shares that the public can trade when calculating market cap. The S&P adjusts each company's market cap to compensate for new share issues or company mergers. The value of the index is calculated by totaling the adjusted market caps of each company and dividing the result by a divisor. The divisor is proprietary information of the S&P and isn't released to the public. The S&P Index, SPX, isn't a total return index and doesn't include cash dividend gains for the companies listed. You can nonetheless calculate a company's weighting in the index, and this can provide investors with valuable information. You can get a sense as to whether it might have an impact on the overall index if a stock rises or falls. A company with a 10% weighting would have a greater impact on the value of the index than a company with a 2% weighting. The S&P 500 is one of the most widely quoted American indexes because it represents the largest publicly traded corporations in the U.S. It focuses on the U.S. market's large cap sector, and it's also a float-weighted index, which is a type of capitalization weighting. Company market caps are adjusted by the number of shares available for public trading. Fast fact: the S&P 500's most recent rebalancing was announced on March 1, 2024, and it took effect before the markets opened on March 18, 2024. Supermicro Computer and Deckers Outdoor replaced Whirlpool Corp. and Zions Bancorporation N.A., respectively at that time. S&P 500 competitors, S&P 500 versus Dow Jones Industrial Average, DJIA. Another common U.S. stock market benchmark is the Dow Jones Industrial Average, DJIA. The S&P 500 is often the institutional investor's preferred index given its depth and breadth. The DJIA has historically been associated with significant equities from the retail investor's point of view. Institutional investors perceive the S&P 500 as being more representative of U.S. equity markets because it includes more stocks across all sectors, 500 versus the Dow's 30. The S&P 500 uses a market cap weighting method that gives a higher percentage allocation to companies with the largest market caps. The DJIA is a price-weighted index that gives companies with higher stock prices a higher index weighting. The market cap-weighted structure tends to be more common than the price-weighted index across U.S. indexes. S&P 500 versus NASDAQ. NASDAQ is a global electronic marketplace for trading securities. Several equity market indexes include stocks traded on NASDAQ. A given stock included in the S&P 500 index may also be in one or more of the various NASDAQ indexes. Some of the most watched NASDAQ stock indices include NASDAQ 100 Index, includes 100 of the largest, most actively traded common equities listed on NASDAQ. NASDAQ Composite Index, often simply referred to as the NASDAQ by the media, includes more than 2,500 common stocks that trade on NASDAQ. NASDAQ Global Equity Index, NQGI, includes international stocks. PHLX, Semiconductor Sector Index, SOX, the leading barometer of stocks related to the semiconductor industry. OMX Stockholm 30 Index, OMXS30, includes 30 actively traded stocks on the Stockholm Stock Exchange. S&P 500 versus Russell Indexes. The S&P 500 is a member of a set of indexes created by Standard & Poor's. This set of indexes is like the Russell Index family in that both are market cap weighted unless stated otherwise, as in the case of equal weighted indexes. There are two significant differences between the construction of the S&P and the Russell families of indexes. Standard & Poor's chooses constituent companies via a committee. Russell indexes use a formula to select which stocks to include. There's no name overlap within S&P style indices such as growth versus value. Russell indexes will include the same company in both the value and growth style indexes. S&P 500 versus Vanguard 500 Fund. The Vanguard 500 Index Fund aims to track the price and yield performance of the S&P 500 index by investing its total net assets in the stocks that make up the index, and by holding each component with approximately the same weight as the S&P index. The fund barely deviates from the S&P in this way, which it's designed to mimic. Important, the S&P 500 is an index, so it can't be traded directly. Anyone who wants to invest in the companies that are included in the S&P must invest in a mutual fund or exchange-traded fund, ETF, that tracks the index, such as the Vanguard 500 ETF, VUO. Limitations of the S&P 500 Index. One of the limitations of the S&P and other market cap-weighted indexes occurs when stocks in the index become overvalued. They rise higher than their fundamentals warrant. The stock typically inflates the overall value or price of the index if it has a heavy weighting in the index while being overvalued. A company's rising market cap isn't necessarily indicative of its fundamentals. It simply reflects the stock's increase in value relative to the shares outstanding. Equal-weighted indexes have become increasingly popular as a result. Each company's stock price movements have an equal impact on these indexes. Let us give an example of the S&P 500 market cap weighting. The individual market weights must be calculated by dividing the market cap of each company by the total market cap of the index to understand how the underlying stocks affect the S&P index. Here's an example of Apple's weighting in the index. Apple, ticker symbol AAPL, reported 15.7 billion shares outstanding in its quarterly filing for the period ending July 1, 2023. And it had a stock price of $173.93 at the end of the trading day on September 21, 2023. Apple's market cap was $2.7 trillion as of September 21, 2023. Market capitalization of Apple, ticker symbol AAPL. The S&P 500 total market cap was approximately $39.7 trillion As of August 31st, 2023, this is the sum of the market caps for all of the stocks in the index. Apple's weighting in the index was approximately 6.8% or $2.7 trillion, divided by $39.7 trillion. The larger the market weight of a company, the more impact each 1% change in a stock's price will have on the index. S&P doesn't provide the total list of all 503 components on its website, just the top 10. You may ask, why is it called Standard & Poor's? The first S&P index was launched in 1923 as a joint project between the Standard Statistical Bureau and Poor's Publishing. The original index covered 233 companies. The two companies merged in 1941 to become Standard & Poor's. What companies qualify for the S&P 500? A company must be publicly traded and based in the United States to be included in the S&P 500 index. It must also meet certain requirements for liquidity and market capitalization, have a public float of at least 10% of its shares, and have positive earnings over the trailing 4 quarters. How do you invest in the S&P 500? The simplest way to invest in the S&P 500 index or any other stock market index is to buy shares of an index fund that targets it. These funds invest in a cross-section of the companies represented on the index, so the fund's performance should mirror the performance of the index itself. What's the bottom line? The S&P 500 index is one of the most widely used indexes for the US stock market. These 500 companies represent the largest and most liquid companies in the US, from technology and software companies to banks and manufacturers. The index has historically been used to provide insight into the stock market's direction. It was created by a private company, but the S&P 500 is a popular yardstick for the performance of the market economy at large. Now remember to subscribe for more knowledgeable information. Like this video so others can learn too, and be sure to click on the notification button for my next update in the series. Cyclical stocks? What are they? Cyclical stocks are stocks that tend to rise and fall in line with the broader economy. Cyclical stocks include those of technology, finance, and energy companies. This contrasts with defensive stocks, which tend to have steadier returns, drop less when the economy falls, and rise less when it grows. What are examples of a cyclical stock, its risk, and return potential? The price of a cyclical stock is affected by macroeconomic or systematic changes in the overall economy. Cyclical stocks are known for following the cycles of an economy through expansion, peak, recession, and recovery. Most cyclical stocks involve companies that sell consumer discretionary items that consumers buy more during a booming economy, but they spend less on them during a recession. Key takeaways: cyclical stocks are affected by macroeconomic changes. Their returns follow the cycles of an economy. Cyclical stocks are generally the opposite of defensive stocks. Cyclical stocks include discretionary companies, such as Starbucks or Nike. Defensive stocks are staples, such as Campbell's Soup. Cyclical stocks usually have higher volatility and are expected to produce higher returns during periods of economic strength. Let us get an understanding of cyclical stocks. Companies with cyclical stocks include car manufacturers, airlines, furniture retailers, clothing stores, hotels, and restaurants. Consumers can afford to buy new cars, upgrade their homes, shop, and travel when the economy is doing well. These discretionary expenses are some of the first things consumers cut when an economy does poorly. Cyclical stocks can become completely worthless if a recession is severe enough, and companies may go out of business. Important investors should be careful about their positions in cyclical stocks, but they shouldn't avoid them entirely. Cyclical stocks rise and fall with the economic cycle. This predictability in the movement of their prices can lead some investors to attempt to time the market. They buy the shares at a low point in the business cycle and sell them at a high point. Investors should use caution about the weight of cyclical stocks in their portfolios at any point in time, but this doesn't mean investors should steer clear of these stocks completely. Cyclical stocks are seen as more volatile than non-cyclical or defensive stocks, which tend to be more stable during periods of economic weakness. However, they offer greater potential for growth because they tend to outperform the market during periods of economic strength. Investors seeking long-term growth with managed volatility tend to balance their portfolios with a mix of cyclical stocks and defensive stocks. Investors frequently choose exchange-traded funds or ETFs to gain exposure to cyclical stocks during expanding economic cycles. The SPDR ETF series offers one of the most popular cyclical ETF investments in the Consumer Discretionary Select Sector Fund, also known as XLY. Cyclical versus non-cyclical stocks. The performance of cyclical stocks tends to correlate with the economy, but the same can't be said about non-cyclical stocks. These stocks tend to beat the market regardless of the economic trend, even when there's a slowdown in the economy. Non-cyclical stocks are also referred to as defensive stocks. They encompass the consumer staples category with goods and services that people continue buying through all types of business cycles, even economic downturns. Companies that deal with food, gas, and water, such as Walmart, are examples of those that have non-cyclical stocks. Adding non-cyclical stocks to a portfolio can be a great strategy for investors because it helps hedge against losses sustained by cyclical companies during an economic slowdown. What is an example of cyclical stocks? Cyclical stocks are often further delineated by durables, non-durables, and services. Durable goods companies are involved in the manufacture or distribution of physical goods that have an expected lifespan of more than 3 years. Companies that operate in this segment include automakers such as Ford, appliance manufacturers like Whirlpool, and furniture makers such as Ethan Allen. The measure of durable goods orders is an indicator of future economic performance. It may be an indication of stronger economic activity in the ensuing months when durable goods orders are up in a particular month. Non-durable goods companies produce or distribute soft goods that have an expected lifespan of fewer than 3 years. Examples of companies that operate in this sector are Coca-Cola and Procter & Gamble. Services is a separate category of cyclical stocks because these companies don't manufacture or distribute physical goods. They instead provide services that facilitate travel, entertainment, and other leisure activities for consumers. Walt Disney is one of the best-known companies operating in this space. Also falling into this category are companies that operate in the digital area of streaming media, such as Netflix. How can I collect income from investing in stocks? A stock is essentially an ownership interest in a company. You own a small percentage of the enterprise when you purchase one or more of its stocks. You'll receive monetary dividends as payment when and if the company does well. You can use them to reinvest and purchase more shares, or you can take dividends as cash payments. You can also sell your stocks. You'll have capital gains income if you can sell your shares for more than your investment in them, including any trading fees. What are some of the best cyclical stocks? The best of any type of stock is the one that most closely accommodates your goals and your risk tolerance. That said, numerous sources will rate individual stocks for you based on other factors. Yahoo Finance recommends cyclical stocks of companies with names that we're all familiar with, like Costco, Expedia, UPS, Airbnb, and Kohl's. What is a countercyclical stock? As the term counter implies, a countercyclical stock is non-cyclical. Its price is inclined to move in the opposite direction from that in which the economy appears to be headed. The prices of these stocks tend to go up when the economy is struggling and a recession is looming or has already begun. What's the bottom line? A cyclical stock moves in sync with trends in the economy. The price soars when the economy is flourishing, but it can just as easily tank in times of recession. These stocks tend to be companies that produce and sell products that are discretionary rather than necessary components of life. Think restaurant chains rather than groceries. Cyclical stocks tend to produce high returns, but this is confined to times of economic strength. They'll tank when the economy struggles. They're volatile and should be balanced with non-cyclical stocks in a portfolio. Join us again in our next video in this series of stocks as we hope for you to be knowledgeable and make informed decisions in your investment journey. As we end this chapter and before you leave, like this video and subscribe to our channel.